No business can survive without investment. Critical capital stakeholders, in turn, rely on good corporate governance. We have investors and capital providers at the Biennial Corporate Governance Conference 2024 to describe what they are looking for in today's rapidly changing world and what they expect from the businesses they may choose to invest in. Mr. Hailiang Zhang, Business Head and Regional Managing Director of the Greater China region of Vistra, will provide insights into China's economic growth, as well as the challenges faced by the global economy. Taking Vistra as an example, he will discuss the actions that Vistra has taken and the services they provide in response to the constantly evolving investment landscape.
Thank you. Good morning. My name is Hailiang. I'm from Vistra. So today, in next 15 minutes, I'm going to talk about a third-party view, how we empower our clients, basically two types. One is private equity investors. Second is corporate, to navigate, to unlock the opportunities in regional and global level. You see that the GDP growth before COVID, during COVID, and post-COVID. Each line represents the major countries, for which you can see that, no doubt, all the countries being hated heavily, negatively during the COVID. But the shape and the momentum comes differently post-COVID. Some countries is growing very strongly, some countries are growing down a bit, okay? Second thing I want to share is some headlines from the business news. Now, if you look at that, the headlines in every day, you will see that China-US relationship still in tension, right? And the last 2 days, the good news is Federal Reserve now is adjusting down 0.5% base points in the interest, which will provide some liquidity to the market, especially to the capital market, especially for the market like Hong Kong. By end of this year, there's going to be another 0.5%. Right, it's good news. But in addition, in the meantime, we see the news is Russia, Ukraine, the war is still lasting. Europe is adding tariff on the new energy vehicles for the China exported manufacturers. So all those are put together, combined together, is created very, very dynamic world or changing world, okay? If we deep dive into the investment world, the data basically showing here is from Preqin, from McKinsey, all the public available informations. So I want to walk through all the details, but you can see that fundraising, the first chart, fundraising is slowing down in 2023. There could be two reasons. LPs has no money, or LPs doesn't want to invest in currently. They're showing the different signals. And if you look down, basically the dry powder is increasing. In the meantime, exit is getting very difficult than ever. But the good thing is, institutional investors still allocate heavily into private sector. So we hope that with that, the Federal Reserve's measures in terms of the interests, that we will see some very good news very soon in Hong Kong capital market. Okay. So from as I said, in this dynamic, very changing world with many growing headwinds, how to really navigate ourselves in this kind of environment? I think number one, from the bottom is, when you're running the business, when you are investing in a business, you better to see what's your plan for the business expansion. Are you going to be a global player? Are you going to be the regional player? Are you going to be the combined players in global and region? Right. Second, with so many choices around, what are the best way to help you to navigate among the regulatory complexities? The last but not least is really the efficiency when you're making investment, when you work on investment, when you're running a business, that what is most efficient way to help you to break even, more than break even. So I'm based in Shanghai. I have a couple of friends who are running the enterprises and also investments. So since last year, the most of topics we're talking about is how you protect you from the loss instead of how you maximize the profits you can earn from the market. So I think all those are reflecting that the business activities or decisions or thinking behind of this changing environment. Okay, today I'm going to share with you one case study, basically two small case studies combined. Because in Vistra we serve fund clients, we serve corporate type of clients. So this is basically, the first client background is global leading PE firms. They're very much specialized in technology, in pharma, in healthcare. They're very, very, very good at USD fund investment. They have been in China for many years, but they're all the time using USD fund to make the investment. During the COVID, and they make a decision that they would like to do the fundraising activities in local, raising the money from the local market and making investment in China. So exit will be easier than ever. Okay, after 1.5 years, they really successfully set up this RMB fund with QFLP structure as a layer to absorb some overseas investments in. In the meantime, they start to operate this RMB fund. They're starting to invest by using this RMB fund into the different portfolio companies across 10 China locations. Okay, I think very importantly, they also pilot with us to build up that target operating model for RMB fund in China. I'm not sure how much of you know about that in China. If you do the fund administration work, which is not like USD fund, basically you need to get a license. And since 2017, there's no any license be given to the market players. Okay, so I'm going to talk about that. And second client background is leading biotech company. They were invested by these PE firms in USD fund before COVID. For getting the investment from USD fund, they need to make the VIE structures. I think the people in this room probably know about the VIE, how you using the agreement to make the Cayman entity or Hong Kong entity owning an operating entity in China, which is kind of revolution of entity structure. And in that case, they finished that all the compliance approval within China and get all the infrastructure set up through the BVI, Cayman, et cetera. And they finally get listed in Hong Kong in 2022. And their market cap is 4.2 billion, if I was not wrong, at that time, and still doing good. So the first client the first PE firm gets a very good return from this investment. Okay, so here I'm going to share with you a few illustrations about the charts. Okay, so this is a typical fund structures, the GPLP, that investing to set up this QFLP fund for overseas LPs. And the domestic LPs also can directly invest in funding this RMB fund and using RMB fund to do the investment through SPVs. And in the meantime, the fund managers, PE firms also set up their China office in China as the fund managers looking after the KLP fund and also the RMB fund. We support them to deal with. You can see that the parties will be involved into a RMB fund day-to-day operations. There will be third party like a valuer evaluate for the valuation. There will be lawyers from the law firms for the certificate, for the license. China is so big. Even the city to city, there are many regulations, different regulations. So one terminology in China we call it the Windows opinion, which is a 窗口意见. So central government try to standardize, but still there's variations. You can see that banks, central banks, et cetera, and also deal with authorities, et cetera. So we help them together with client to deal with those complexities and bring the efficiency back to the client. And this one is for the second case study, illustration about the structure, how this investment structure goes. You can see the BVI. BVI represents founders, ESOP represents employees' benefit after the IPO. And you can see Cayman listing companies is a member of the company that get listed in Hong Kong. Right? So I think the key point I want to talk about is we used about 2.5 months to finish all the ODI regulatory approval for our client, for this company basically. And also, since after A1, that within 4.5 months, we get this company listed. We're part of the IPO journey because we provide support to them in share registrar. We provide the service to them in cold stack. The reason why we can be so efficient, so convenient, because we have the network set up across Greater China for this purpose. 18 cities, I think, we're the biggest one player in this market who can leverage the resources around. Okay, so by giving those two case studies, basically I want to tell is, although it's a changing environment, but still we have the opportunity to grow. Okay, so few takeaways. Number one, embrace changes. People say only change is not going to change, right? So embrace changes. And also, as I mentioned, when you look at your business, balance your local and global needs. You don't have to go global for globalization. You need to back to the business nature of your investment, of your enterprise. And be compliance-oriented, be efficient enough, right, to make your portfolio more competitive in the market. And the last but not least is be a friend of the time. I'm not saying you're waiting, but you still need to work hard to be ahead of the curve. Then you will be winning the game in the end. Okay, thank you. That's for my sharing.
Next, Ms. Devyani Daga, Managing Director of Cambridge Associates, shares her insights into the evolution of investment decision-making. She will also share her experiences executing and evaluation of private investments. She then discusses managing change within organizations and within the context of private investment.
Great. Good morning, everyone. My name is Devyani Daga, and I work at Cambridge Associates. We're a global investment firm, and we build customized portfolios for institutional investors by picking the best fund managers. I'm hoping to spend the next 15 minutes with you all just to give you an insight into how investment decision-making has evolved from an institutional investor perspective. And I'll really focus on two key areas. The first is sustainable investing, and the second is private investments. The first topic, as I mentioned, sustainable investing. But before we get into the details, let's just do a quick recap of the terminology. You see a number of different terms on the page right behind me, all with a shared meaning, but a slightly different focus. In this alphabet soup of MRI, ESG, and SII, let's just focus on the two terms that we hear most widely. The first one is sustainable investing, which is essentially the integration of environmental, social, and governance considerations as part of investment analysis to identify both material risks as well as growth opportunities. The second one is impact investing, which is making investments with the intention to generate a positive and measurable impact in addition to financial returns. Just to help put these terms in context, what you see on this slide is really how the dialogue with respect to sustainable investing has evolved over time. In version 1.0, investors were predominantly focused on avoiding bad outputs. So really the kind of stuff they did not want exposure to in portfolios. This could really span across a range of alcohol, tobacco, gambling stocks, and anything else that investors feared were not suitable investments. Version 2.0 moved on to include outputs that investors did want in portfolios, and this is really the impact investing terminology that I described previously. This could be focused on climate solutions, resource efficiency, or any other desired positive outcome from portfolios. The key linkage here is in version 1.0 and 2.0, the emphasis has been on outputs of the portfolio or investment decision-making process. Version 3.0, which we are referring to as sustainable and impact investing, is really shifting the focus purely from outputs to portfolio inputs. So what more can we add to the investment decision-making process to improve the output of the process? What do I really mean by that? ESG analysis can generate meaningful, valuable information about companies, assets, and investments that does not typically feature in financial and regulatory documents, but nonetheless can be valuable and material financially. This is not a replacement for traditional fundamental research. but rather it can actually enhance the investment analysis process if we add more information with respect to ESG. Why bother with this at all? Why should we really care about this? We believe that markets don't exist in isolation. They don't exist outside of well-functioning societies and on a planet that's unsustainable. And there are a number of trends that you can see on this slide here that are likely to have implications for portfolios over the long term. Just taking climate change as an example, there are risks and opportunities from the energy revolution and shift to a lower carbon economy. An increasing number of asset owners, governments, and businesses are taking action around climate change. Impact for investors to consider include transition risk to high carbon businesses if we move to a lower carbon economy, and direct physical risk to assets if we don't. These sustainability trends are disruptive, will not mean revert, and will take the investment landscape to somewhere new. These trends are material, but can be mispriced and overlooked by investors who may have a shorter time horizon and may place over-reliance on history in the face of ever-changing issues such as climate change. But ultimately, just going back to the question of what's in it for me, ultimately for investors, risk-adjusted returns is the focus. I would argue that ESG analysis can help uncover fundamental investment factors that can be highly material to long-term returns, but absent from standard reporting. These factors help to determine sustainability risks, and ignoring them runs the risk of placing investments in your portfolio that might avoid looking at some of the risks that could be financially material over the long term. Equally, they may identify structural return drivers from the evolution of the economy. And ignoring ESG considerations could mean missing the winners of the next decade. So really, increasingly, investors have begun to view ESG considerations and ESG frameworks as additional tools and lenses to generate enhanced returns and mitigate risk. And we've seen this across our client base as well. So as you can see on this slide, we've done a survey of our clients to see whether such sustainable and impact factors have been integrated into the investment decision-making. Back in 2016, a third of the respondents said they were doing this. And when we did the survey 2 years ago, 2/3 of the respondents were integrating impact and sustainability factors in their investment decision-making in some way or the other. The focus for these investors, amongst the area of focus, has also been climate, which has been top of mind. Again, with climate, I think we generally have buy-in from a personal perspective. I live in Singapore and I live in a perpetual summer. I can't bear to imagine it being hotter than it actually is. I have an eight-year-old daughter and nephews and nieces, and I do think about the kind of world and planet we are going to leave behind for them. But really outside of that, coming down to really from a risk and return perspective, why should we bother? We know that to achieve a reduction in global carbon emissions, we need to decarbonize almost all areas of the economy. And this presents risks as well as opportunities. The first is transition risk, which is really the risk to investments from carbon being taxed more heavily in the future, from more stringent regulation, from companies facing lawsuits due to perceived impact of climate, and the increasing risk of consumer pressure. And all of this does translate to actual costs for companies and the impact on a company's value. The second one is physical risk to assets, which is really the increasing weather and climate-related impact on physical assets, including storms, wildfires, etc., which we all know have become more frequently in the recent past. If climate change is allowed to continue progressing, then physical risks will continue to grow in magnitude and severity. Alternatively, as climate change is increasingly tackled through policies, the impact of transition risks becomes more significant. As material climate change is now unavoidable, impact to portfolio from both these sources of risks is inevitable. All of this sounds very doom and gloom. So what can we actually do? We believe that the baseline for investors should be climate-aware investing. So really knowing what you own in portfolios and where the risks and opportunities lie from a client perspective. The emphasis really is on maximizing risk-adjusted returns in a changing world and employing climate-competent managers as far as possible. We believe that climate should become a regular part of manager diligence, dialogue, and investment underwriting. And we believe that investors are increasingly and should increasingly place larger emphasis on portfolio managers to include climate in the risks and opportunities that they consider. And we would expect portfolio managers to, in turn, engage with portfolio companies and help us through this energy transition. Shifting gears a little bit and looking at asset allocation trends over time and what has influenced investment decision-making. We all know that asset allocation is a fundamental aspect of portfolio management, and it's the key driver of returns over the long term. Private investments in particular are expected to provide portfolio growth over the long term and can generate substantial returns. Hailiang shared similar data, but we have similar data as well across our client base, which shows that over the long term, over the last 20 years, one trend that we've seen is the allocation to private investments has increased substantially over time, from under 5% maybe 20 years ago to close to 20% today. What we've also seen is that investors with the highest returns have typically been those which have had the highest allocation to privates. On the vertical axis, returns, and horizontal axis, allocation to privates. And the dark blue circles that you see there are investors with over 15% allocation to private investments. The return differential between investors with little private investments to investors with the highest allocation to private investments over the last 20 years, annualized, has been almost 2%, and this does compound and add up over time. This is not going to be new information to any of you, that private investments can generate high returns, but from a total portfolio perspective, particularly for investors who have not embarked on this journey yet, what are the things to keep in mind? Adding private investments to the portfolio requires a different approach compared to public investments. Building up the allocation takes time. You can't get there tomorrow. You should diversify across vintage years. So if you start today, you'll get there in year 6 or 7. In the meantime, it does have implications on portfolio liquidity and cash management, etc. And you are locking your money away for over 10 years. So this is a very different mindset and shift in mindset compared to traditional public investments. Add to that, and this is an interesting slide which shows you dispersion in manager returns across traditional investments in the gray bars on the left-hand side and private investments in the blue bars on the right-hand side. Couple of observations here. The first one is the dispersion in returns between the bottom and top quartile managers for private investments is much larger compared to traditional assets. What this means is that while there's significant upside, there's also higher downside compared to traditional investments. And what this makes manager selection and diligence ever so important and critical. You want to be in the top quartile, obviously, within this chart, and imagine ending up in the bottom quartile where you've locked your money away for 10 years and actually you walk away with less than you started. That's not a good outcome. The diligence and evaluation of private investments is also further complicated by the expansion of the private markets. This is how they used to look previously, and this is where we are today. So lots of choices for investors to be making, lots of decision making here. I'll also leave you with this. What these charts are showing is that while established funds, which are essentially funds for funds 5 and onwards, form a critical part of private investment portfolios, we've also seen that new and developing funds, which are funds 1 to 4, have also dominated the top 10 sort of performance returns in the top quartile of private managers. These funds typically will not really have a track record that you can evaluate. They don't really have that, so you can get that comfort that they've been around for a long time, but adding them to portfolios can help with returns. So compared to traditional investments, from a total portfolio perspective, privates are more complicated to evaluate and implement, and portfolio construction mindset is slightly different. But they also offer significant upside compared to public markets, and investors who have leaned into private investments have benefited significantly. I've said a lot of things today, but there are 2 things that I'll leave you with. The first is that sustainability trends are disruptive. They will not mean revert, and they will take the investment landscape somewhere new. Systemic risks such as climate change affect all asset classes and so are relevant for all investors to consider in their investment decision making. The second is that private investments have the potential to deliver superior returns compared to traditional public markets, but require a different approach and more time spent on diligence and portfolio construction. Thank you.